We're in stage 5, not speculation, not fear-mongering. Pattern recognition, WANA, mathematical, unstable. History doesn't negotiate, it repeats. And if it repeats this time, as it has for centuries, we have exactly 18 months from right now until the moment most fortunes will be erased. 18 months from stage 5 to the precipice. It's the timeline history hands us. Like a clock ticking in plain sight, look back to 1929. From the moment the insiders noticed the first cracks to the Dow losing 89% of its value, exactly 18 months passed. Every month, every move, every panic can be mapped. The stages, the panic waves, the false hopes, the slow grinding descent, these all there documented. And the astonishing part, the pattern never changes. Human psychology, leverage, and greed are constants. In September 1929, stage 5 began. The market was at unprecedented high. Optimism was unanimous. Hubris, universal. Everyone believed this bull market would last forever. Meanwhile, the smart money quietly exited, selling quietly, systematically, leaving retail investors to chase the dream. Margin debt, already massive, had reached 8% of GDP. Stock valuations had divorced themselves entirely from reality. The math was clear. Collapse was inevitable. By October, the crack appeared, the first tremor of liquidation. November and December offered false hope, temporary rebounds that misled the unprepared. From January to June 1930, the decline was slow but inexorable. By July, the pace accelerated, and by early 1931, capitulation swept across the markets. By March 1931, 18 months after stage 5 began, the Dow had fallen from 381 to 160, a staggering 58% drop. But even this was not the bottom. The final low, 2 years later, reached 41, an 89% total loss. The 18-month mark, however, is where the devastation is concentrated. Fortunes vanish, the middle class is obliterated, wealth transfers to those poised to act. Now, consider today, November 2025, we are at that same stage 5 moment. Indicator mirror 1929 with unsettling precision. Insiders are offloading positions at record levels. Margin debt is approaching 8% of GDP. Warren Buffett is sitting on $325 billion in cash, his largest allocation ever. Valuations are divorced from fundamentals. The smart money is gone, and as in 1929, the 18-month countdown has begun. If history repeats, May 2027 will mark the point when most wealth has shifted from those forced to sell to those ready to buy. Let's step back into 1929, the world on the brink. September, the Dow closed at 381.17, an all-time high that would not be revisited for a quarter century. Newspapers were euphoric investment. Advisors preached buying more. Economists like Irving Fisher spoke of a permanently high plateau, but beneath the surface the story was starkly different. Joseph Kennedy, one of the decade's most shrewd financiers, began liquidating his holdings. He understood margin debt. When stocks are purchased on 10% margin, a 10% market decline wipes out equity. Brokers then liquidate, forcing prices further down. The cycle feeds itself, damn mathematical inevitability. Bernard Baruch, another veteran of panics, had moved to cash and government bonds by September. He had seen bubbles before the 1907 panic, countless smaller collapses, and knew the signs. Mania, religious certainty in the market, dismissal of dissenting voices. European money too was quietly fleeing, and British banks had been selling American stocks since August. Drawing lessons from the South Sea bubble of 1720 and railway mania in the 1840s, corporate insiders were liquidating massive positions, not for diversification, not for tax reasons, but systematic exit. They unloaded 50%, 60%, even 70% of their holdings. Earnings had peaked in Q2 1929. Factory orders were falling, industrial production weakening, commodity prices were in retreat, and yet stock prices continued upward, untethered from reality. The classic hallmark of stage 5. Rising prices sustained only by belief, momentum, and collective optimism. Fast forward to today, the Dow and S&P hover near all-time highs. Warren Buffett's $325 billion in cash dwarfs prior allocations. Corporate insiders are selling at levels unseen since 2007. Margin debt is approaching its historical trigger of 8% GDP. Earnings are stalling. Revenue growth is slowing. Profit margins compressing. Will stock prices remain elevated, as if untouched by economic reality? Sound familiar? The pattern is identical. September 1929 was stage 5. November 2025 is stage 5. History is whispering, and the echoes are unmistakable. October of 1929 began with unease. High volume during a mature bull market, a subtle but unmistakable signal. Distribution, smart, money selling to the masses. Then came the first tremors, October 18th, a sharp drop, October 21st, 22, more selling, October 23rd, panic. JP Morgan's tightens, Lamont, Wigan, Mitchell formed a pool to stabilize markets. Headlines declared, bankers saved the day. But the panic had only begun. Margin calls flooded in over the weekend. By October 28, the Dow fell 13%. Tuesday, the 16 million shares traded, a 12% drop. In 2 days, the market had lost a quarter of its value. But here's the key. This was the crack, not the crash. The moment forced selling began, leverage started unwinding. The devastation would unfold over 18 months. Not a single day of panic. What this teaches us is profound. Crashes are not accidents. They are the predictable result of mathematical pressure, human psychology, and structural leverage. Optimism, denial, and hubris can delay recognition, but they cannot prevent outcomes dictated by debt, margin, and fundamental divergence. The system obeys its own rules, indifferent to hope, media narratives, or political assurances. November 2025 is our September 1929. The clock has started 18 months until the majority of the damage is done. The question is not whether it will happen, it is whether you will survive it, or be swept into the wake of history. October opens with unease. The market is jittery, some days up, some down, but the volume is unusually heavy. To a trained eye, this is not mere fluctuation. High volume in a mature bull market signals distribution, the smart money quietly selling to the less informed. The first tremors appear on October 18th. Prices drop sharply but recover by the close. It feels like a blip, a temporary disturbance, yet underneath leverage is unwinding, margin calls are brewing, and a storm is forming. By October 21st, 22, selling intensifies. Heavy volume pushes prices lower. The psychological tension builds. On October 23rd, panic begins. Midday, a consortium of bankers, Kuhn, Thomas Lamont, Albert Wigan, and Charles Mitchell assemble at JP Morgan. Their goal? Stabilize the market. They form a pool to buy stocks, injecting confidence, headlines, trumpet, the rescue. The public believes the crisis is averted, but it isn't. Margin calls continue flooding brokers over the weekend. The accumulated pressure is ready to be released. October 28 arrives. Massive selling overwhelms buyers. The Dow plunges 13% in a single day. The following day, October 29, Black Tuesday, the most infamous day in financial history, sees 16 million shares change hands. Another 12% drop occurs in just 2 days. 25% of the market's value is gone. But remember, this is not the crash. This is the crack. The first moment forced selling emerges, the initial unraveling of leveraged positions. The real collapse is still ahead. While the public sees panic, there is another timeline almost invisible to the masses. The actions of smart money. They watch sectors, track insider movements, and position themselves for the months ahead. This hidden timeline, imperceptible to ordinary investors, is where the real strategy is played out in modern terms. Think of this as observing hedge fund positioning, insider trades, and leveraged exposure before the next domino falls. Knowledge of these subtle shifts is what separates those who survive from those who are destroyed. After the initial crash, something unexpected occurs: stabilization. From early November through December, prices fluctuate, but do not collapse further. The Dow is roughly 30% below its peak, yet the public begins to believe the worst is over. Newspapers call it a healthy correction. Investment advisors label it a buying opportunity. Retail investors, lulled by the rebound, step in. This is the dead cat bounce down temporary illusion of recovery. It's deceptively comforting because hope is contagious, but beneath the surface damage is spreading. Banks quietly absorb losses from margin loans. Business experience tightening credit. Layoffs begin, and unemployment creeps upward. Economic pain is mounting, but it's invisible to those fixated on the stock tickers. Those who buy into the bounce believe they are seizing a bargain. History shows they are making the gravest mistake. By December, unemployment rises, defaults increase, and regional banks begin failing. Over 600 banks closed in the first 6 months of 1930. Communities lose trust in financial institutions. Deposits vanish overnight. The psychological toll is brutal. Individuals, believing the worst is past, watch their wealth evaporate month after month. This slow, grinding decline is far more destructive than a single dramatic crash. Now, fast forward to today. Imagine November, December 2025. Market indices hover near record highs, yet credit markets show cracks. Regional banks are vulnerable. Corporate earnings are weakening. The first shock, perhaps a bank failure, a major earnings Miss or jewel event triggers a cascade. Expect an initial sharp drop, 3% to 5% in a single day, unusual but not unprecedented. The next day, institutions attempt stabilize, driving a small rebound, then a larger decline follows, 5% to 8%. Finally, the crack, a 10% to 50% drop over 1 or 2 days. Do not mistake stabilization for safety. The dead cat bounce is coming. Media will declare the bottom reached. Analysts will urge buying. Retail investors will believe they are seizing opportunity, and, as in 1929, the illusion will prove fatal. Those who enter at this point will watch the portfolio shrink by half or more over the next year. From January to June 1930, the market enters a slow grinding decline. Month by month, new lows form. Every rally fizzles. Every small piece of optimism is crushed by worsening economic data. Factory production falls. Unemployment rises from 3% to 8% by mid-1930. Commodity prices collapse. Farmers cannot sell crops for sufficient profit. Companies reduce wages to avoid lace. Regional banks fail quietly, absorbing losses, creating a silent panic. This is where psychological destruction becomes most severe. The public initially hopes for recovery. They believe the market will rebound, but the slow grind erodes confidence, exhausts patience, and traps investors in losing positions. Wealth is siphoned from those clinging to hope into the hands of those prepared with liquidity. The process is systematic, relentless, and almost invisible to the majority. Using the 1929 timeline as a blueprint, the first half of 2026 mirrors the grinding decline. Market indices drift lower, not dramatic crashes but through constant psychological attrition. Corporate bankruptcies rise, job losses increase, eroding consumer spending, regional banks falter, and credit tightens. Trillions of dollars of market capitalization vanish, largely unnoticed until the psychological and economic strain is undeniable. Central banks will intervene, cutting rates, restart quantitative easing, injecting liquidity, but monetary policy cannot solve a debt-saturated system. When balance sheets are destroyed and leverage is overextended, printing money cannot compel borrowing. The economy is fighting gravity, and policy is powerless against fundamental overextension. By July 1930, the slow grind reaches its tipping point. The market begins to accelerate downward. Forced liquidation dominates. Individuals who held out hoping for a rebound finally sell. Mutual funds face redemptions, selling to raise cash. Banks and insurance companies, facing losses and claims, liquidate stock holdings. The market becomes one-sided. Sellers overwhelm buyers. Bid-ask spreads widen. Liquidity evaporates. Prices crater. By November, the Dow is at 180, a 53% decline from the peak. December brings further devastation. Normally, optimistic holiday periods are grim, stores are empty, communities are frozen in survival mode. Over 1,000 banks fail by the end of 1930. Trust in the financial system is shattered. The domino effect, bank failures, touring business collapses, job losses, and mortgage defaults, creates a feedback loop of economic destruction. Here lies the essence of systemic risk, interconnectedness. Bank failures lead to business failures lead to layoffs depress consumption, which harms businesses further. Mortgages default, feeding back into banks. The system becomes self-reinforcing, a machine of destruction once leverage reaches critical mass. History repeats because humans underestimate feedback, overestimate resilience, and ignore mathematics in favor of hope. By January 1931, the social and economic fabric of America is fraying. Unemployment has surged to 15%. 1 in 6 workers has lost their jobs. Industrial production is down 30% from the peak. Steel mills operate at 30% capacity. Auto plants are silent. Construction is halted. Bread lines snake through major cities. Churches and charities are overwhelmed. Entire communities live in makeshift encampments, Hoovervilles, named after the president, whose policies have failed to halt the collapse. The stock market mirrors the despair. The Dow hits 160 in February, a 58% decline from the September 1929 highs. By March, prices stabilized temporarily at that level. This is the 18-month mark, that pivotal moment in the cycle. Here, the bulk of the wealth transfer has occurred. Those forced to sell, middle-class investors, over-leveraged individuals, and small businesses, will have already been liquidated. Those positioned with cash, understanding the mathematical inevitability of leverage unwinding, acquire assets at deep discounts. It's critical to recognize the bottom has not yet arrived. In 1932, the Dow will fall to 41, a near total collapse, an 89% loss from the peak, yet the 18-month mark represents the most brutal phase of destruction. It is when fortunes are obliterated, confidence evaporates, and psychological exhaustion reaches its zenith. Survival, not gain, becomes the most valuable currency. Let's transpose this historical pattern onto our current timeline. November 2025 represents the September 1929 moment. Indicators are strikingly similar. Insiders separate, executives and directors are liquidating positions at record levels. Over the past 6 months, insider sales have outpaced buys 20-1, the highest ratio since 2007, immediately prior to the last crash. These insiders have intimate knowledge of their company's earnings, balance sheets and debt loads. Systematic liquidation, not diversification, taking place. Cash hoary Warren Buffett, historically a master of opportunistic timing, is holding $325 billion in cash, his largest position ever. A quarter of Berkshire Hathaway's value sits in short-term treasuries, waiting for fire sale opportunities reminiscent of 2008-2009. Margin debt approaching 8% of GDP. Margin debt acts as a mathematical trigger. Once leverage reaches this level, any price decline initiates forced selling cascading through the system. It's automatic, unavoidable, and historically predictive. Value-us, the Shiller-Pay ratio stands at 35, well above the historical average of 16. Only 3 previous periods have exceeded 30, each followed by severe market corrections. The market is priced for decades of perfect growth. Any disruption guarantees a collapse. Economic data, GDP growth is slowing. Manufacturing and service PMIs are contracting. Commercial real estate defaults are accelerating. Regional banks are already failing. Corporate earnings are flattening. Stock prices, however, remain disconnected, sustained by optimism rather than fundamentals. Market sentiment. The psychology mirrors 1929. Confidence is unshakable. Retail investors believe in perpetual growth, assuming Federal Reserve interventions will prevent any major downturn. AI and technology are seen as invincible engines, justifying irrational valuations. Skeptics are dismissed, often mocked. The conclusion is unavoidable. We are in stage 5. The 18-month countdown has begun. The path forward requires discipline and timing. History offers a blueprint. Phase 1, November to December 2025. De-risking this is your last window to reduce exposure. If heavily invested in equities, trim positions, target allocation 50% or less in stocks. Move profits into cash or short-term treasuries. Speculative stocks, high-flying tech, XPSE, narrative-driven assets, they at the first to collapse. Consider protective measures such as put options on major indices, SPY or KUKO. Spending 2. Fast 2 December 2025 to January 2026. The crack and dead cat bounce, the first major decline, 10% to 50%, will trigger false hope. Media and analysts will proclaim a buying opportunity. Ignore it, the market may rally 10-15% temporarily. Use this bounce to fund de-risking. Do not confuse this stabilization with a bottom. This is month 1 of 18, the illusionary safety net before the next leg down. Phase 3, February to June 2026, the grind down. This is the hardest period mentally. Each month brings new lows. Every rally fails. Economic data deteriorates. Friends and family lose jobs. The temptation to act impulsively, either to buy or sell, the overwhelming patience is your asset. Those in cash observe while over-leveraged positions hope. This is the period of maximum psychological pressure, where most wealth is destroyed not through dramatic crashes, but through exhaustion and compounding losses. Fast forward July 2026 to March 2027. Capitulation and opportunity by this phase, forced liquidation accelerates. Market declines reach 60%, 70%. Unemployment surges. Bank failures, corporate bankruptcies, and societal panic dominate headlines. Fear is universal. This is when opportunity arises for those prepared. Deploy capital, gradually scaling in as prices fall 50%, 60%, then 70%. Focus on strong companies with low debt, essential products, and enduring competitive advantages. Apple, Microsoft, Visa, Johnson & Johnson, Procter & Gamble. These are not speculative plays. They are assets that survive systemic disruption and will thrive long-term. This is wealth transfer at its rawest. From panic-driven sellers to disciplined, patient buyers. History is clear. Individuals who invested in 1931-32 after the initial 18-month decline accumulated generational wealth. Those who bought in 2009 experienced similar exponential returns over the subsequent decade. Today, the same principle applies. Surviving the crash is the prerequisite for building extraordinary wealth. The beauty and brutality of leverage is mathematical. When debt is pervasive, Optimism is irrelevant. When margin loans dominate, price declines trigger automatic liquidation. Markets are deterministic in these phases. Adding recognition, not speculation, is the key. Just as in 1929, the sequence from stage 5 to the 18-month mark will unfold with precision. Insider selling, margin unwinding, declining corporate earning, psychological exhaustion, and eventual capitulation. March 2027 marks the modern 18-month threshold. By then, the bulk of wealth transfer will have occurred. Retail investors holding leveraged positions will have suffered losses of 60%, 70%, while disciplined holders of cash or defensive assets acquire quality holdings at historically unprecedented discounts. Mathematics, not sentiment, dictates the outcome. By mid-2026, the slow grind of the previous months gives way to full acceleration. The market no longer grinds, it collapses. July alone sees declines of 15%, followed by another 12% in August and 18% in September. The catalyst is not a single event, but the convergence of multiple stresses. Forced liquidation, bank failures, corporate defaults, and collapsing consumer confidence. The cycle of hope and despair that characterized the slow grind now gives way to sheer panic. Individuals who held on during the grind finally break. Mutual funds and investment trusts, overwhelmed by redemption requests, must sell assets at fire sale prices. Banks needing liquidity liquidate their holdings. Insurance companies facing claims divest, with selling far exceeding buying. Prices crater, bid-ask spreads explode. Want to sell 100 shares? Expect the bid to be 20% below the last trade, and tomorrow it could be 30% lower. Survival instinct dominates. Liquidate now, no matter the cost. As in 1930-31, bank failures occur in clusters, not a handful but dozens at a time. Regional banks, heavily exposed to commercial real estate and corporate debt, fail. The FD, with about $130 billion in insurance reserves, faces trillions in insured deposits. Even insured depositors may suffer losses. The domino effect is immediate. Bank failures trigger business defaults, which trigger job losses, which trigger mortgage defaults. Feeding back into more bank failures, community experience the economic equivalent of a hurricane. Coal businesses close, unemployment surges to 12–15%, and household wealth evaporates. In towns across America, the collapse mirrors the social devastation of Hoovervilles in the 1930s. Citizens lose trust in the financial system. Protests, unrest, and calls for radical reforms erupt. Populist movements, left and right, gain traction. Politics becomes inseparable from economics. The market reflects the social panic as much as corporate fundamentals. From November 2025 to March 2027, the 18-month pattern repeats with unnerving precision by March 2027. The Dow has fallen roughly 670% from its 2025 highs. The S&P 500 has lost 2/3 of its value. Individual stocks may have lost 80–90%, some going to zero. Trillions in wealth have shifted, not vanished, retail investors to those positioned with cash or defensive assets. This is the modern manifestation of what happened in 1931. A systemic, mathematical transfer of wealth from the over-leveraged, overconfident, and psychologically exhausted to the disciplined, patient, and prepared. Joseph Kennedy, Bernard Baruch, the Rockefellers. Historically, these individuals and families multiply their fortunes by buying at the bottom. In 2027, the same principle applies. Courage and liquidity determine outcomes. The timeline will provide visual and mental cues for survival. Observing the pattern rather than panic is essential. Insider actimony. Watch corporate executives and directors. Record-level selling indicates the smart money is exiting. Margin debt crossing the 8% of GDP threshold triggers forced liquidation. This is automatic. Mathematics is impartial. Economic debts, declining GDP, restricting manufacturing, accelerating defaults, and rising unemployment signal worsening systemic stress. Sentiment extreme confidence or denial from media and investors often precedes sharp declines. This time is different. Narratives are classic stage 5 signals. Bank and corporate failures, names of institutions you never expected to fail suddenly emerge. Early failures foreshadow deeper systemic risks. Recognizing these signals allows preparation and timing, choosing when to preserve capital, when to buy, and when to wait. Economic collapses are as much mental as financial. The 18-month decline isn't a single dramatic day. D is relentless, grinding, and exhausting. Each month brings new lows. Every rally fails. Every positive headline is overwhelmed by bad news. Investors experience fatigue, frustration, despair. During this phase, ordinary investors often make critical mistakes. Panic selling, chasing dead cat bounces, or holding over leveraged positions out of hope. History shows these mistakes are fatal. Multi-portfolios that lose 30-40% in month one often lose an additional 50-60% over the next year. The psychological toll exceeds the financial toll. Survival requires discipline, patience, and cash reserves. Patterns are cyclical. 1929 mirrored in 2008, and history is now repeating itself in 2025-2027. Lessons emerge. Liquidity is king. Cash allows strategic buying at the bottom. Leverage kills. Margin debt acts as a deterministic trigger for forced liquidation. Psychology drives price. Mass optimism fuels bubbles. Mass panic accelerates collapses. Wealth transfer is inevitable. The 18-month stage is the fulcrum, the pivot point, where fortunes change hands. Survival precedes opportunity. Only those who preserve capital through the crash can participate in the recovery and long-term gains. In 1931-32, the survivors, who invested after the 18-month mark, accumulated generational wealth. In 2009, post-crisis buyers gained 500% over the following decade. 2026-27 offers the same window. Disciplined, prepared individuals can acquire quality assets at unprecedented discounts. The mathematics, psychology, and historical precedent all converge to this moment. Financial history is not random, it is cyclical. Booms lead to overconfidence, bubbles inflate on optimism, leverage amplifies risk, and collapses occur with ruthless precision. The 18-month framework illustrates a pattern embedded in human behavior and mathematical reality. Yet crises are also moments of clarity. They expose systemic weaknesses, separate disciplined actors from the reckless, and create the conditions for long-term opportunity. Economic collapses are not merely tragedies. They are reconfigurations of wealth and power. For those who understand the rhythm, the crash is less a threat and more a strategic opening. History teaches patience, courage, and vigilance. Financial markets are predictable in pattern, if not in exact timing. By observing the signals, acknowledging stage 5, and preparing for the inevitable 18-month grind, individuals can survive the collapse and participate in the recovery. November 2025 marks the beginning of the modern stage 5. March 2027 will be the 18-month threshold when most of the wealth transfer has occurred and the market has shed 60%, 70% of its value. The pattern is clear. Insiders sell, leverage unwinds, the economy deteriorates, markets grind lower, capitulation arrives, and opportunity emerges for those with cash and courage. This is not prophecy, it's pattern recognition. Grounded in history, mathematics, and human behavior, the crash will not occur in a single day. D is an 18-month journey. Survival requires discipline, awareness, and patience. Opportunity awaits those prepared to act after the destruction, not before it. Your decisions in these months, whether to de-risk, hold cash, or scale into quality assets, will determine your financial trajectory for the next decade. History repeats, not because humans are ignorant, but because the same dynamics, greed, leverage, belief, and fear, persist in every era. The 18-month countdown has begun. Position yourself wisely, observe, wait, survive, and prepare to act. When the cycle completes, the transfer of wealth will be as profound as it was in 1931, shaping generational fortunes for decades to come. The 18-month collapse is not hypothetical. It is a timeline backed by historical precedent, financial mathematics, and human behavior. To navigate it, we divide it into 4 strategic phases, each corresponding to distinct market psychology, economic signals, and wealth transfer opportunities. This is the last window to protect capital. Stage 5 is underway. Insiders have sold, valuations are stretched, and margin debt nears critical thresholds. In 1929, September was the final calm before the October crack. In 2025, November is that moment. Key actions: reduce exposure for heavily invested portfolios, 80-90% stocks, cut to 50% or less. Focus on cash and short-term treasuries. Preserving capital outweighs chasing late cycle gains. Trim speculative holdings. Tech stocks with sky-high multiples, meme stocks and SBACs are the first to collapse. History warns. ROCA lost 97% in 1929-30. Speculative assets today face similar risk. Protection: small positions and put options. 2-3% of portfolio on broad indices like SPY or QQ can multiply 10-20x if markets drop 50%, providing a hedge against the inevitable crack. The mindset: patience is critical. Sitting in cash is psychologically painful as prices appear to climb, but this phase is about survival, not chasing gains. Once the first 10-15% decline occurs, do not buy the dip. Media and analysts will assure you that fundamentals are sound. They were wrong in 1929. They will be wrong again. Expect initial stabilization or a small rally due dead cat bounce. Use this temporary optimism to exit any remaining speculative or high-risk holdings. The market at this stage is psychologically deceptive. Those who buy during the first bounce often lose 50-60% more over the next year, repeating the same mistake that destroyed middle-class wealth in 1929-31. This is month-by-month attrition. The market loses 30-50% from peak values through relentless declines. Each rally fails. Economic data deteriorates. Banks quietly report losses. Corporate earnings compress. Unemployment rises. Lessons from 1929 and 2008. Every rally is a trap. The slow grind is more dangerous than dramatic crashes. Psychological resilience is paramount. Do not buy prematurely. Cash holders wait. Panic sellers accelerate wealth transfer. Watch for failed rallies of 10-15%. These signal that the dead cat bounce is over and the next leg down is imminent. Modern parallel in 2025-26, expect similar stress on tech, commercial real estate, and leveraged financial institutions. These sectors will amplify the grind-down effect as failures propagate throughout the system. The market now enters full capitulation. Selling accelerates dramatically as hope evaporates by March 2027. The Dow may have lost 6-70%. Individual stocks could be down 80-90%, some to zero. Trillions of dollars of wealth transfer from forced sellers to positioned buyers is largely complete. This is the window for disciplined, prepared investors. Historical patterns illustrate that buying at the bottom generates generational wealth. 1931-32, early buyers multiply fortunes over the next 20 years. 2009, post-financial crisis, investors saw S&P 500 gains exceeding 500% by 2019. 2026-27, the same opportunity will arise for those with cash and courage. Strategy for this phase: scale into quality companies with strong balance sheets, low debt, and essential products. Think Apple, Microsoft, Visa, Johnson & Johnson, Procter & Gamble. Deploy capital gradually, starting when markets are down 50%, increasing at 60% and 70% declines. Avoid speculative assets. Focus on survivable, essential, and long-term growth businesses. The principle: wealth is not created during bubbles. He is preserved and acquired during destruction. The 18-month timeline is where fortunes shift from panic sellers to disciplined buyers. Insider selling. Executives offload positions at record ratios. Liquidation is systemic, not cosmetic. Margin debt approaching 8% of GDP during automatic forced selling. Economic weakness. Slowing GDP, contracting manufacturing, commercial real estate stress, rising unemployment. Media proclaiming this time is different. AI or tech justification narratives. Bank failures. Dozens of regional and mid-sized institutions failing in clusters. Recognizing these signals allows investors to act with precision, not panic, and participate in the eventual wealth transfer. Financial crises are patterns of human behavior, amplified by leverage, optimism, and denial. They are relentless, yet predictable. Stage 5, optimism, crack, dead cat, bounce, grind down, capitulation, and finally opportunity. The 18-month framework illuminates this journey. Mathematics and psychology converge. Leverage triggers, forced selling, mass panic, amplifies, declines, and wealth shifts from unprepared to prepared. From September 1929 to March 1931, the pattern was clear. Those with liquidity survived. Those over-leveraged lost everything. From November 2025 to March 2027, history repeats the lesson. Preserve capital, survive the grind, observe signals, recognize stage 5 dynamics. Prepare to act, deploy cash strategically after the capitulation. International wealth is built not by chasing bubbles, but by holding the discipline to act when markets are darkest. The 18-month countdown has begun. November 2025 is the September 1929 moment. March 2027 will mark the pivot where opportunity emerges for the discipline. The clock is ticking. The question is not if, but how prepared you will be. History is relentless, indifferent, and beautifully instructive. The collapse of 1929 was not an anomaly. It was the inevitable consequence of human behavior under leverage, optimism, and greed. The same dynamics that created the Great Depression are playing out today in a modern guise. As we stand in November 2025, the echoes of September 1929 are unmistakable. Valuations divorced from reality, margin debt teetering near all-time highs, insiders quietly liquidating, and the majority of the public still intoxicated by the illusion that the good times will last forever. Every speculative bubble carries the same fingerprints, from the South Sea bubble of 1720 to the dot-com frenzy of 2000, the housing crisis of 2008, and now the extraordinary highs of 2025. The psychology is universal. Fear and greed, optimism and denial, confidence and hubris, all converging to create stage 5. It is a story repeated in human history, a story we can read, anticipate, and learn from. We are not dealing with prophecy. We are dealing with pattern recognition. The 18-month cycle is mathematically, historically, and behaviorally grounded. In 1929, the 18 months from stage 5 to the peak of destruction saw the Dow lose 58% of its value. Trillions in today's money shifted hands. By 1932, the bottom was reached, an 89% collapse. In 2025, we see the same signals. Insiders selling at historic ratios, Warren Buffett holding unprecedented cash reserves, margin debt at critical thresholds, corporate earnings faltering, and optimism reaching irrational levels. History does not repeat perfectly, but it rhymes and rhyme it does, loud and clear in the data, in sentiment, and in behavior. It is not just numbers on a chart. It is human suffering and opportunity intertwined. During the grind-down phase, from February to June 2026, the market will chip away at confidence. Month by month, paper wealth will evaporate. Friendships, family, and community confidence will be tested. Unemployment rises, businesses close, banks fail, and the middle class experiences the harshest impact. Yet amid this destruction, opportunity arises. The disciplined, prepared, and patient, the ones who move to cash, buy protection, and observe signals, will be positioned to acquire assets at fire sale prices. History is clear. Wealth does not disappear, it transfers. The 1930s created the foundations for fortunes that still influence America today. The 2009 crisis created billionaires and lifelong generational wealth for those who acted wisely. 2026-27 promises the same potential for those with courage and preparation. At its core, the crash is mechanical. Margin debt is the accelerator, leverage is the fuel, and panic is the ignition. When debt is high and prices begin to fall, forced selling begins. Automatically, mathematically, no optimism, no hope, no Federal Reserve intervention can stop it. Monetary policy cannot reverse human behavior under leverage. This is why the 18-month timeline matters. It is not speculation, it is execution of financial physics, just as gravity cannot be argued with. Leverage unwinds on its own schedule, unaffected by headlines, tweet, or policy statements. Stage 5 psychology, market euphoria, and denial of risk. 1929 newspapers assured the public of a permanent plateau. 2025 media speaks of AI, innovation, and, this time is different, insider behavior. Executives systematically selling. In 1929, Joseph Kennedy exited early. Today, Buffett's cash hoard signals similar foresight. Economic divergence. Corporate earnings peaked while prices rose in 1929. In 2025, earnings are plateauing, yet valuations remain extreme. Margin mechanics. Forced selling in 1929 amplified declines. Margin debt approaching 8% of GDP in 2025 sets the stage for automatic liquidation. History is repeating, but on a modern canvas. Technology, globalization, and monetary expansion create the environment. Yet the core mechanics and human behaviors remain the same. The lessons of history are not just financial, they are human. Crises expose our biases, our impatience, and our hope for permanence. Stage 5 is the ultimate test. Will you succumb to fear or greed? Will you follow the crowd or follow the signals? Wealth is not created during the frenzy, it is preserved, acquired, and multiplied during moments of fear. Those who panic sell lose everything. Those who observe, prepare, and act wisely inherit the fruits of market chaos. This is why the 18-month countdown is critical. It is a test of discipline, foresight, and courage. And it is not just financial. Navigating this period builds resilience, strategic thinking, and patience, the traits that define generational wealth, not just dollars. November 2025, stage 5, insider selling, high leverage, extreme valuations. The calm before the storm. December 2025, January 2026, crack and dead cat bounce. The illusion of recovery, do not buy prematurely. FRO June 2026, the grind, month by month, attrition. Patience is paramount. July 2026, March 2027, capitulation and opportunity. The moment when wealth transfers, cash becomes power. The message, survive, observe, and deploy strategically. Your choices in these 18 months define whether you are destroyed or positioned for generational wealth. Picture the Dow in March 2027, 70% lower, Headlines scream despair, banks fail, jobs vanish, families struggle. But somewhere in quiet homes, disciplined investors are buying. Not recklessly, not emotionally, but with a calm, deliberate understanding of history. They are standing at the crossroads of fear and opportunity, and they choose courage. This is the essence of financial evolution. Crisis destroys the unprepared and empowers the patient. The 18-month countdown has begun. November 2025 is your September 1929. March 2027 is the pivot. History is indifferent, but it is precise. Mathematics and human behavior march forward, whether you heed them or not. And when the dust settles, the lessons remain. Preparation, patience, and perspective create survival. Courage and timing create legacy. The story of 2025-2027 is being written now. Where will you stand when it is told?